The HFRI 500 index is the investable version of the widely used HFRI fund-weighted composite. It consists of approximately 500 funds. These funds tend to be larger, with average assets above 500 million. They are also more liquid, with quarterly or better liquidity and no lockups or gates. And overall, the index is constructed to reflect the industry strategy composition. With performance going back to 2005, the HFRI 500's construction fulfills all benchmark requirements, with a methodology that adheres to the CFA's best practices, is IOSCO compliant, and is independently audited on an annual basis. This family of indices consists of an aggregate index representing the overall hedge fund industry. Funds are classified into 4 main strategies: global macro, equity hedge, event-driven, and relative value, along with 26 sub-strategies for a total of 31 benchmark indices. The HFRI 500 follows a methodology that operates under the same constraints as an actual hedge fund investment portfolio, taking into consideration realistic market conditions, issues and solutions, as well as time frames such as notice periods, trade dates, and settlement periods. Constituent funds must be open for investment with at least quarterly liquidity and no lockups or gates, so that tracking funds can provide investors the same liquidity with minimal tracking error to the published benchmark. HFRI 500 index trackers do not use synthetic replication. They deliver the index return by investing in all the constituent funds at the same weights as the index. HFR's index clients range from seasoned hedge fund investors to those in the early stages of researching the market. They represent a broad range of views and approaches to hedge fund investing, but no matter where they are on the investment spectrum, they all benefit from an investable hedge fund index. An investable hedge fund index provides 4 important solutions for investment. 1. A fair investment comparison. 2. A way to reduce unfunded exposure risk. 3. A way to reduce active selection risk. And 4. A way to invest passively. The first solution provides a benchmark that is a fair investment comparison. The unfair investment comparison problem arises when an active portfolio's performance is compared to a theoretical benchmark, such as a non-investable hedge fund index or a formulaic index such as LIBOR plus 3%. Neither represents a return accessible in the market, so comparing the portfolio's performance to such a standard is considered unfair. However, the investable HFRI 500 raises hedge fund indices on par with traditional benchmarks, allowing active portfolios to be compared with actual performance, rather than theoretical market returns. The investor now has a choice: to invest through an actively selected portfolio or through a passive benchmark tracker. The passive investment option sets a floor for performance expectations and provides an accurate measurement for determining the value added of an actively selected portfolio. The second solution provides a way to reduce unfunded exposure risk. Unfunded exposure risk occurs when an asset allocation mandate remains unfunded and therefore does not earn the market premium. There are various reasons for underfunding. These include the time it takes to implement an active selection program, the time and resources of the hedge fund due diligence process, and overweight cash positions carried while rebalancing between funds and strategies. However, once a decision has been made to allocate a percentage of the portfolio to hedge funds, there is an opportunity cost for the non-invested portion of those assets. That is, it will not realize the hedge fund market return and diversification benefits. From a portfolio management perspective, capturing this hedge fund market premium may be preferred over a cash return for these assets, especially when cash returns are low or even negative. The ability to earn the hedge fund return through HFRI 500 index trackers provides a way to eliminate or significantly reduce the unfunded exposure risk. The third solution provides a way to reduce active selection risk. Active selection seeks to outperform the market at the risk of underperforming it. By selecting a more concentrated subset of funds based on various qualitative and quantitative factors, it excludes other funds' performance in the benchmark. Depending on the hedge fund strategies and sub-strategies selected, and the concentration of the selection, the dispersion of performance outcomes can be significant. In the past, active selection was the only option for investing in hedge funds. But now, HFRI 500 index trackers provide investors a way to reduce active selection risk. By adding the benchmark returns to an actively selected portfolio, the dispersion of returns is reduced by the percentage of the benchmark exposure in the overall portfolio. For example, one could implement a core and satellite investment approach, where the core exposure invests in the benchmark index to capture the benchmark return, while high-conviction satellite funds are selected to enhance the core exposure. The fourth solution provides a way to invest passively. A growing number of institutions invest passively by allocating capital to index funds that track their asset class benchmarks. But historically, passive investors lacked a way to access the hedge fund market premium. While hedge fund returns could have benefited their portfolios, the lack of an investable index ruled out hedge funds as an investment option. However, the HFRI 500, through index trackers, opened the hedge fund market to passive investment. Furthermore, investing in an index provides investors with several benefits, which fall into three general categories: simplicity, risk reduction, and low cost. Simplicity because investing in index trackers is an easy, turnkey way to access the hedge fund industry's performance. Risk is reduced in a number of areas. The unfunded exposure and active management risks discussed earlier are eliminated. The broad diversification provided by the large number of funds in the index reduces volatility and minimizes single manager risk, including headline risk and style drift. Finally, index investing can be achieved at a much lower cost than taking an active management approach, which provides both internal operational expense savings and lower fund fees. Investors take a variety of approaches to hedge fund investing and have different benchmark needs and uses. But whether one is looking for a hedge fund benchmark that provides a fair comparison for evaluating active portfolio performance, an efficient way to eliminate unfunded exposure risk and to earn the industry return on a temporary basis, a way to reduce the active management risk of return dispersion that's inherent within the hedge fund universe, or a simple and low-cost way to access the hedge fund benchmark return, the HFRI 500 investable indices could be the optimal solution.